Hey everybody, I hope everyone is doing well and had a good day. Thank you for joining me for today's end of day review for the Emini 5-minute chart for Monday, February 9th, 2026. I'm going to keep it brief today. We'll look at the chart as a whole and focus on the 5-minute. So going into the day, looks like a trading range on the open based on the context from the prior day. Tight trading range, bull breakout, and it's parabolic, so possible exhaustive buy climax. We talked about that on the prior day, Friday. Strong bear reversal, a pause, and then a big second leg down. So the bears have a breakout, but then there's a strong reversal on the open today. So the gap down into the day, it's only from the close of bar 81 to the open of bar 1 today, but the market sold off to the low of bar 1 and then reversed bar 1, a strong bull reversal bar closing near its high, and strong follow-through bar on bar 2 with another, albeit weak, small follow-through bar on bar 3. So 3-bar micro channel, but the signal a really decent reversal and follow through bars 1 and 2. So second leg up likely. What about the bear breakout? Well, the bears possibly have a completed structure with 78 being the breakout bar, and it has a lot of overlap, followed by a pause, trading range bar, inside bar, another small bar, and then it looks like volatility expansion again. So leg 1, pause, leg 2, strong reversal up. Bulls need a second leg, so any reversal here, any reversal down is likely minor, and there's evidence bar by bar. If you look at bars 4 and 5, market sold off, rallied, sold off a second time, rallied a second time, tried to rally a third time, but that's 3 pushes down against a strong reversal and follow through. Also about a 50% pullback, that's typical support. And bulls are likely to get a second leg. Second legs are often symmetrical in size, and sure enough, the bulls get their symmetrical second leg from the low of bar 5 to roughly the close or the high of bar 10. So another, looks like a tight bull channel, looks like a pullback on bar 7. Maybe it looks like a 2-tick pullback there, and a 1-tick pullback on bar 9. So the rally from the low of bar 7, bar 5, or really the low of bar 7, to the high of bar 10 or 11 is really strong. You have to ask yourself, well, when I say it's a really strong rally, you have to understand why I'm saying it's a strong rally. It's not enough to try to memorize what the bars look like. There has to be a deeper understanding of the underlying market behavior. And that's why the perspective of breakouts and trapped traders is so helpful. Try to imagine how difficult it is for a trader to make money selling from anywhere in this area, from bar 5, 6, or especially 7 through 10. It's virtually impossible for a trader to make money selling. On the smaller time frames, you would see a 2-legged correction from the high of bar 8 to the low of bar 9. There's 2 legs in there, 1, pause, 2. But it's so minor, it's not even worth trying to, in my opinion, not worth trying to short and trying to capture any profit from a decline in the price. If anything, it's easier to make money going long, and that's kind of the logic with understanding when the market is always in long, and then it's easier to make money trading in the always in direction. It was always in long on the close, probably on the close of 1, but certainly on the close of bar 2. It's always in long. So if you buy, scale in, you're probably going to make money. Worst case, you'll maybe break even most of the time. And then we have to quantify the strength of the rally from the low of 5, or really for any period of time, for a bar by bar analysis. You quantify the strength of the reversal and follow through, quantify the strength of the breakout, the pullback. So the reversal follow through is the breakout signal. 3, 4, 5, 6 is the pullback. So you quantify strength versus strength. That's why it's important to, I think, have a systematic approach to your analysis, like a reliable way that you interpret the price action, and you look at the chart the same way every time. And I'll talk more about this in future videos. I'll dedicate videos to this topic specifically. But basically the point I'm trying to make is that it's not enough to try to listen to my reviews and memorize what the bars look like. Like, oh, Joseph said that the breakout from bar 7 through 10 is strong. So if I see another breakout that looks like this, then I should buy, because context plays a big role. But also, it's not enough to look at a breakout like this and to say that it's strong. Like, reading and memorizing, this is a big mistake I made, so I think it's really worth sharing. Reading and memorizing information doesn't do you any good, or trying to repeat information that you hear doesn't do you any good. It's really the understanding, the deeper understanding, and then application of the ideas that makes the difference. So I read Al's books several times. I went through the course several times, which you definitely have to do. Repetition is an important law of education. To actually learn something, you have to go back and repeat what you're doing and repeat what you're learning. But the point is, reading and memorizing or trying to repeat what you hear is not enough. A trader has to take the time to understand the underlying market behavior, what actually creates the price action that we see on a chart, and then align their actions with the market's behavior. And it's awesome because the institutions are who control the price. The market is a collection of institutional behavior. And what's really cool is that the institutions cannot hide what they're doing. It's shown right here on the chart. Price action is the footprints of institutional behavior. And as cool as that is, you have to understand what it means. And that's another topic. I think we all give our own meaning to everything in our lives. So if you want to understand price action, you have to go to a reliable source. And it's not enough, in my opinion, to try to take everything they say as a sure fact. What I would do, if I could go back in time and change my perspective, is I would read what Al puts out, the information that Al shares, the information that Ali shares, what I share. Anything you hear is worth inspecting that idea. I wouldn't just instantly accept it or reject it. And the third option is to neglect it. It's up to you to take the information, take the ideas, and see what works. You have to do your own tests and see what works for you. All of that to say, this rally is strong enough for a second leg. It's really difficult to make money selling through here, which means traders are trapped. Bears who were selling are holding losing positions, and the bulls who did not buy, they're trapped out on the sidelines. And that creates a certain level of demand. There's trapped traders on both sides. Bears are trapped into losing positions, and they're just hoping to break even if they can. And the bulls are trapped out of a winning position, which is commonly referred to as FOMO, fear of missing out in trading. The bulls are on the sidelines wishing they had taken the trade, and they're also looking to participate in the breakout that is successful. And the third group of trapped traders are the bulls who did buy, but when they bought here, they were buying lower probability. When you buy before the breakout, it's lower probability because you get better risk reward, and the breakout is evidence of trending behavior in your direction. So the bulls who bought earlier probably bought smaller position sizes, and now they're they're wishing they traded a larger position. So the bulls who had bought are looking to add to their already winning position. So you have the bears who sold, scaled in, anyone selling through here losing money. The bulls who did not buy, obviously they're trapped out on the sidelines, and the bulls who did buy wish they had traded or taken a bigger position. So after a breakout like this, everyone is looking to buy, which creates a level of demand, which reduces the depth of the pullback. It very likely reduces the depth of the pullback to something relatively shallow, and there's a high probability of a symmetrical second leg in the direction of the breakout signal that is similar in size to the breakout signal. So 2 legs up here, tight bull channel, and this rally very likely to get a second leg. Reversal follow through 11-12, but minor reversal. The bull channel is too tight, and the reversal bar not especially big, follow through bar not especially big. It's really a 2-legged correction on a smaller time frame. 1 pullback, 2 testing support. Bar 9, breakout point created by bar 10. Any trader who, see if we can visualize this as an example. Let's say a bear looks at this and says, this looks like a trading range. Big up, big down, 2 legs. This is a second leg trap at resistance in a trading range. I'll sell above bar 9 and sell more at a new high. The bear who sells here. They're trapped into a losing position. Maybe they sell more, and they're just hoping to exit maybe with a small loss, with a small win, or at break even if possible. They use the reversal and follow through 11-12 to buy back shorts. The traders who are trapped, the bears who are trapped into a losing position, buy back shorts. The bulls who did not buy the shallow pullback, and the traders who did buy but wish they had bought bigger also buy. They scale in on the pullback, and then we get another leg in that direction. Another breakout strong enough for a second leg. Where are traders making money selling through here? They're not. So it's similar to this one. Second leg up is likely. Any reversal likely to be minor. What about leg count? Leg count is important for minor reversals, legs in trading ranges, for counting the number of attempts in a pullback and counting the number of legs in a trading range. But here, this is a tight bull channel, and it's a bull trend. It's a breakout on a higher time frame, and it's okay to buy at the high of the day of a trend. It's okay to sell at the low of a bear trend. So this is basically a high 2 bull flag at the high of the day, bar 16, but that's a very reasonable trade to take. Yes, you're far above the moving average, and it's leg 3, but like I said, you don't want to count legs necessarily, or you count, the interpretation of leg count is different in a trend than in a trading range. So you definitely want to avoid buying leg 3 in a trading range, especially at resistance, but in a trend, leg count is less important. You really don't want to be fading a bull channel like this. So it doesn't matter if it's leg 3, leg 5, it's always in long, so your options are to be flat or long. So tight bull channel, it's a breakout on a higher time frame, higher prices likely. Then I was saying you're buying far above the moving average in leg 3, but you're getting above average bullishness. Strong reversal follow through here, minor reversal. Strong rally, minor reversal. Strong rally, probably minor reversal. So it's okay to buy far above the moving average when the momentum is strong enough to do that. And it's up to the individual to decide when that's acceptable and when it's not. That's why, again, quantifying the price action systematically is extremely helpful. Testing the bull channel line. Again, I'm trying to keep it short. I don't want to go bar by bar. Breakout of the channel line, small two-legged correction. Maybe it's a trading range bull flag here. Evolved into a bigger high 2, so high 1, high 2, resumption, but also 1 pullback 2, resumption. And then here, another push in the direction of the trend, still always in long, but at this point, getting 30 bars into the trend, getting a tight trading range far above the moving average. So now we've gone sideways for 5 bars, far above the EMA, 30 bars into the trend. So it's possible we're getting into correction territory. You've heard Al talk about this in the video course. Once you're 20 or 30 bars into a trend, a couple of things can happen. You can get an exhaustive buy climax, like over here, well into the trend, obviously, clearly more than 30 bars into the trend. And then you get the really strong bars here, 75, and even bigger bar, 77. This became an exhaustive buy climax and led to a minor reversal, the evolution into a trading range. Strong reversal, second leg down. So that's a possibility. Another possibility is we get a tight trading range like today. Tight trading range. So now how can you justify buying this far above the moving average in a tight trading range? Bars are getting smaller and you're 30 bars into a trend. So you may be getting a correction. First hour of the day, or first third of the day. It's kind of the first section. You can usually break the day into different times of day. That's another thing talked about in the course. I won't get into it right now. But the point is we might be entering a correction where we can go sideways for a couple of legs. We can test all the way back down here, maybe even lower. So staying long, not ideal if you're able to manage the position, especially as a day trader. Bear breakout followed through 35, 36, second leg down likely, possible final flag. Bears strong enough breakout here for a second leg. Breakout follow through, 3-bar micro channel, minor reversal, second leg. You can count pauses, so 1, pullback, 2, pause, 3. So possible parabolic wedge breaking below a channel line for the bears, but tight bear channel through here. So second leg down likely. Any reversal likely to be minor, but minor reversal is likely because 3 legs down to the channel line and other support. And what happens? We get a minor reversal, 2-legged correction, test the bear trend line. Actually might be a wedge bear flag on a smaller time frame. 3 legs, 1, 2, 3, then a bear reversal, pullback, and then a big, basically a second leg trap on bar 47. Testing that, or breaking below the bear channel line again. Testing support to the left. This tight trading range was support, became support after the bull breakout, and then maybe inside bar 15 here. Breakout, brief test, follow through, more follow through. That becomes support. Leg 1, pullback, leg 2. Looks like we're in a trading range at this point. Bears have certainly broken the bull trend line. Strong bull trend, but the past 15 bars or so, we've gone more sideways to down. And the bulls who had bought here are now disappointed with the depth and duration of this pullback. It looks like we're no longer in a strong bull trend. It looks like we're in a trading range. Now it might be establishing support here, and there's probably resistance at the high because of the trend line break. Bull trend, trend line break, that creates resistance in this area, near the high of the day, the horizontal line. Inside bar 48, trading range bar, since it's an inside bar. You can count 2 or 3 legs down, maybe you count 3. 1, 2, 3 tests of a bear channel line support, and again, dueling lines, breakout of channel line and testing support. So this is basically a late leg near the middle or lower third of a trading range. So 48, not a great place to sell. Outside up 49, probably always in long above 49. Out of habit, going bar by bar, again, trying to keep it short today. So always in long above 49. Pretty strong reversal on 47. And context supports a test of the high, because you don't typically get a strong bull trend into a strong bear trend. Usually you need the evolution into a trading range first. Tight bull channel, trend line break, and then test of the high likely, which we got in 2 legs. 1, pullback, 2. Smaller structure, you can count 3 pushes here in the second leg. So this being the first leg, pullback, second leg. The second leg has 3 pushes of its own. 1, pause, 2, pause, 3. Look at bar 59. Bull breakout bar. It's a strong bar, but the majority of the bar is not breaking out of the resistance to the left. So only a small, maybe 20%, 25% of the bar actually breaking out. The follow-through bar, a trading range bar, looks like closing below its midpoint, bar 60, and not closing above the high of the prior bar. So signs of weakness, signs of trading range behavior. Also a measured move target, leg 1, pullback, leg 2. So failing just below that, finding resistance. 61, reversal bar, always in short below it, despite the strong rally, 57, 58, 59, because context is different. That's why understanding context and the way you quantify breakouts themselves with the bars, bar by bar, but then also incorporating context is important. It's different context in the beginning of the day versus here. We've had an established bull trend line break, and now we have a retest of the highs with a 2-legged completed structure. It looks like a weak breakout at the high, not what you want to see for a trading range breakout, and then a reversal bar, so always in short below 61. Or you can wait for the bear breakout and sell the close 70. So we found resistance at the high, endless pullback for the bulls. Bulls looking for a breakout, pullback second leg. Instead it failed. Sell the close 70, test of the bottom of the range, or somewhere in the low of the range. Lower third of the range is likely. Looks like we're in a trading range at this point of the day. And what happens when we get near support? This is a climactic parabolic breakout on a more clear on a smaller time frame. The channel line, something like that, and it's strong here. Bar 70, context is good. Gets a follow-through bar, that's good. But then a bigger bar 72, another big bar 73. Now we're getting back toward support. So if you see a bar like 74, that's an always in flipping bar, even though it's a strong micro channel. And I say it's always in flipping. It's really not the ideal terminology, because always in is for trending behavior, and in a trading range, always in kind of breaks down, or it reverses quickly. Like selling, if you're selling here and then you get a bar like 74, you have to get out above it. But then when 74 gets a pullback, an attempt at a second leg, maybe even an attempt at a third leg, and then you look to the left, and this micro channel for the bears needs a second leg, you're at the 50% pullback. It's like always in long above 74. But then once you get to this 50% pullback with the weak momentum, breakout, pause, small breakout, attempting to break out, moving average resistance, 50% pullback resistance, it becomes always in short again quickly. And then the bears get a second leg down after this breakout. So trap traders above, breakout, pullback, sellers, second leg, but support at the new low, bottom of a trading range, which makes sense. All right, that's going to do it for today's end of day review. I want to thank everybody for taking the time to watch today. And for more resources to help you on your trading journey, I encourage you to explore the links in the description. All right, thanks again, everybody. and I hope everyone has a good night.